All right, Kyle, let's get into this. And this, we get a lot of calls and we talk with a lot of people and sometimes we find that, when people reach out to us, they are, they're maybe they've set their goals, maybe they're looking at some future aspects and and sometimes they're like, "Hey, I heard you talking about whole life insurance or permanent insurance."
Mhm.
And they're curious to be like, "I think that might be a good move for you." And then we're like, "It's not. It's not." Like actually it's not a good move for you. And you're like, wait a minute, like I thought that that was your thing. I thought that you guys really think that it's an important tool to use in your wealth building journey. And we do, but it's not for everybody. And in
Right,
this episode, what we want to do is talk about why some folks shouldn't consider this tool in their building journey yet. And I think
right.
that's the qualifier right now. So if you're listening to this and you're like, I haven't say bit off. I don't know. I was trying to come up with some fancy way of saying like, taking a
Struggling though.
step forward, or like I haven't bit the bullet. I
Yeah.
don't know if that's a phrase, but I mean, like I just made it up. But I mean, like, if I haven't started that pathway and using that tool, you're going to listen to this one and go, should I, or maybe I'm going to rule myself out
Yeah.
because John and Kyle said it's not for me.
Right, right. And the part that I think is really interesting in the financial landscape out there is that now I'm not going to speak for everyone. I think in this industry, right? So I am licensed to do life insurance and accident and sickness and all of that wonderful stuff, but
Sure.
I do it for very specific purposes and very specific people. And I find that, and I don't know, I don't know all the other people out there, but, there's definitely a picture that's painted about anyone who quote unquote sells life insurance. In a way, we've had episodes about how selling, like this idea of selling has like a negative
Right.
connotation. But in reality, what I do is I work with people who actually need it. So, what we're going to talk about here is we're going to talk about the very specific people who actually, and I'm going to use the word need permanent insurance. And then we're going to talk about who those people are, because if it isn't you, then you don't need it. And that's okay. And I think that's the really important piece here. So we're all about making sure that we're helping people to get further in the journey. And something that's really interesting, and I think what has worked really well for us and the people and the clients we serve, and actually many of those people being listeners of this show, is that those who are on a wealth building journey will typically hit this, we call it a fence post in
Mm-hmm.
in the journey, right? Like you will hit it, but you're not necessarily hitting it straight into your first job. You're not
Sure.
going to hit it when you just had a couple kids and the mortgage payments and the budget's out of control and you don't have any money to invest, or it feels like you don't. Like that is not when you should be buying permanent insurance. So today what we want to do is we actually want to take you through and talk to you about all of the people who should not be buying permanent insurance at this point in their journey. And
Mm-hmm.
here's the interesting part, is that usually people will eventually hit a fence post in the journey where it will make sense. We'll talk a little bit about that later, because even right now, some people in your mind, the way we are thinking today, you're going, I will never need permanent insurance. Like you may feel that way after this episode, but I'm going to say things could change later. And we'll talk a little bit more about that.
Yeah, and they probably will. Will not say could. They will. Things change. That's just
Mhm.
how you're. If you think back 10 years ago, you are kind of a completely different stage. I'm sure, as we are, than you were, back then. Let's specifically, talk about probably the one of the big ideas around life insurance in general, because we've talked about this repeatedly on the podcast when we refer to term life insurance, permanent life insurance, and thinking about you know the mindset around insurance. Like you said, like people are saying, "Oh, it's an insurance salesman. It's
Mhm.
rigged." We just got off a call with someone saying like it's rigged in terms of the insurance company. Therefore, I am going to lose on this scenario.
Mhm.
And so, therefore, if I'm going to lose on this scenario, why would I want to give the insurance company more money than I have to? So when you think about people going, why would I like maybe term insurance is better for me? Whole life is probably not the move for me if I have that mindset. So as you think,
Sure.
sometimes it's like a thing about a mindset idea in terms of insurance. So for example, if I believe, and this is probably an ignorance thing about whole life insurance or permanent insurance around what it really means. Like we looked up on a blog, and I think it was, what was it, Kyle? It was
Nerd
the
wallet.
Nerd Wallet. And Nerd Wallet was basically saying, like, if you look at the two and why you might not want to choose whole life insurance is sometimes it costs 20 times as much.
Mm,
And when I read that, I'm like, well, it's, you know, like that argument here isn't as valid as what you need to make that argument, because you're, if you look at it as a cost, and when I hear the word cost, I'm hearing like, that's out of pocket. I will never see that money again. It cost me $10 to buy this thing. You know, to buy term insurance, sure, you're gonna pay that over the course of a term. You're never going to see that money again. You covered your life, and in case of something happening, you know, your life is covered and your beneficiaries will get the value of that policy that you set up in terms of the term. So when you say like, oh, if I want that same effect, if I go into this kind of thinking going like, I just want to be able to cover my life so my beneficiaries get paid out while I'm working, and that's the way I think about my life insurance, then you're right. Whole life is not for you. And
totally.
you are looking at it as a cost, because in order to get that same death benefit, you have to pay a lot more money up
100%.
front on terms of the premium. But where that article did not elaborate at all is they're saying sometimes it costs 20 times as much. Well, like, it does, but that money's put over there for you in the cash value, and it's still there for you. Like,
Hmm.
it doesn't go away. So it didn't cost you extra money. You know, it may have cost you the same amount of money, but they put this little dollar amount in this bank account in a way over here for you to say, hey, you still got a cash value attached to that you'll always get back or you'll always have access to.
Right.
And that's the difference there. But going back to who whole life is not for, is if I have that mindset that insurance from my life is just to cover my life and that is it, then you should be going term.
Absolutely. And you know what? I look at it and I think like there are times in your life where term insurance, I would say early in the journey, that should be probably the only type of life insurance you have at that point, unless you have a
Right.
high enough income where you can be thinking further down the road. But if you're just trying to get things going, I mean, this idea of, term and invest the difference totally makes sense at that point in the journey, at that early fence post, totally makes sense. Now, some fee for service financial planners will say, well, listen, you could still get it to pay out, because remember, if it's a term 10, term 20, you can renew after the 10 years or after the 20 years, but the cost goes so high that typically people cancel and it actually isn't going to pay out. So it acts like auto insurance, home insurance, these types of
Right.
insurance that you hope you don't ever have to use, because if it's term life insurance, it probably means that it was an untimely death. We don't want that, right? So we don't want it to pay out. So this is money going in and it's not coming back to you. Whereas permanent is money that will come back to you or your estate. So that's very different. We're going to talk about when that might make sense, but early in the journey doesn't make sense. If you are considering term 75, term to 100, those types of things, just I would say do a legit comparison, because the amount of cost that you will put into those and you may still cancel and get nothing back from it can be really risky. Like you have to know ahead of time, like, hey, how long am I going to do this? And will I commit to this thing for the duration of my life in order for you to potentially be in competition there with that permanent insurance, but no leverageability. So for those people looking for the short-term stuff, definitely not a good fit for you. I want to move on to the next one. And
Yep.
this kind of ties to a very similar fence post in life. It's like, okay, I've got to cover myself for my income. I was married when I was 25. So my
You
wife
were?
and
You were married?
I still am. I still am. Yeah. Don't let Chantal know I said that. But we had insurance there because we started to live a lifestyle that required, when I say required, we got used to, right? The
Mm,
lifestyle inflation that happens is you get used to living off these two incomes. And let's be honest, when you have two incomes in the household, it's not like everything doubles, right? Like your cost of owning your home doesn't double and all of those things, right? So we had some insurance to kind of cover the other in the case that one of us had an untimely death. That's term insurance. And then we started investing the rest. So
Right.
what we want to say is this next fence post, it's a very similar place in the journey, is like if you have little or no net worth or little or no net investments of any type, then permanent insurance probably doesn't make sense for you. So
Yeah.
specifically those people who don't have maybe RSPs started or significant amounts yet, or they don't have their tax-free savings account
Right.
bucket full, or they haven't considered RESPs for their
Now,
kids, those types of things. Like you have to really think about like permanent insurance is the idea. Like it will be helpful as it builds, of course, but you need to start taking care of these, I'll call them the first fence posts in the road before you start flipping all of your thought and attention towards
right.
something like permanent insurance.
Now, something that we've said here on the podcast is that, we want all as many of our dollars to go into a policy because we can put two uses to the same dollar on that policy. So, our kind of our strategy is like, let's put it over there first, and then we're going to take it from there. We're going to put it in and we're going to invest it, and or we're going to buy a property with that, and we're working on the arbitrage between the interest rates because we're borrowing to make more money, and therefore we should make sure our gains are higher. So, because of that, and let's say you're past the point a little bit where you're comfortable, and this might start early, especially if you are single in a way, Kyle. Like I feel like this is, don't tell my wife this, but I mean, like I felt like I had way more money than when I was young than I had when I started my family, right? Like all of a sudden it's like I feel like it's all spent somewhere, right? But it's like you have your income, and let's say you had that income and you didn't have double income right away. You lived with by yourself for the first few years. It's like, okay, I'm paid off. I've got extra income here.
And you could
I
live off craft dinner
Right.
for,
Like exactly. You're not
dinner,
like
lunch,
caring about all
everything.
those things that some other people and families start to care about, and where there's some of that money's going to go. And it's like, should I? So here's a question. It's like we talked about, getting the RRSP started, getting the tax-free savings account started. Like, what about getting your whole life policy? So is it for, we know it's not a whole life, or a permanent insurance policy is not for someone who is scraping by and making sure that all of their bills are paid for. But when I start to have a little bit of discretionary income, obviously we're teaching people, and people teach people to kind of go, let's put this away and put it in our tax-free savings account. Let's start maxing those things out. Let's get the RSPs rolling. But
Mhm.
should the first stop be the whole life policy, or should we be maxing those other things out first?
Well, I think honestly, that one is really dependent on what is going to be invested inside those buckets. So that it's a great question. It's a great wonder. And I have this discussion with a lot of people. If your plan is that you're going to put it into a policy and then leverage it for
Mm-hmm.
investing,
Mm-hmm.
we're
Mm-hmm.
100% on board for that. That is awesome. Like that's an amazing strategy. Here's where the nuance comes in: is what are you investing in? How confident are you in those investments? So for example, if I'm going to leverage against my policy, so I say I put in, $12,000, or maybe I put in, $30,000 into a policy over the first year, and I put that money there as the first stop, and then I leverage in order
Mm-hmm.
to put it into my RSP. That can work if the investments inside the RSP are going to give you a positive arbitrage, right? So
Right.
we don't want to be
Right.
borrowing against this bucket, which is going to grow tax free. It's going to pay out a death benefit down the road. Like it's going to do all kinds of amazing things. If I'm going to leverage that 30,000, which again, we don't have access to all 30,000 in year one. So there's an opportunity cost there. So then I leverage it. I leverage what I can take out of it at that time. Let's say it's low $20,000. I put it in my RSP. Maybe I get a tax refund back to pay back towards this loan. Whatever you want to do, awesome stuff. But if I'm going to put it in that RSP and then I'm going to put it into a fund that's balanced, for example, like it's a balanced fund earning
Mm-hmm.
around the same amount as what your policy is going to be growing at, right?
Right.
That overall, over the life of this policy is probably going to be, if it's designed well, between 4-ish to 5-ish% tax free. If you throw it into the mutual fund and you're earning 4 to 5%, like that's not going to be the best move. If you're
Right.
putting it into 100% equities, maybe it's US equities, and you're setting and forgetting and letting it roll, and you're earning 9 or 10 on average, over the life of that, then it could make a ton of sense. So it's all about strategy and what the intentionality is about it. And remember, there's two sides here. We have the rational side where you go, hey, on
Right.
paper, this all makes sense. But then, like, are you going to actually do it? Like, are you actually going to do it? So I'm always a little hesitant for someone, especially if they haven't, quote unquote, started the journey or they're very fresh in the journey. I'm hesitant on getting them to do that bucket unless they're like, hey, I'm all in on real estate, or I'm all in on, like on alternative asset classes. If I'm going to do those types of things, totally for it. But again, I'm going to say that's not like the majority of people that we run into, even those who are listening to the podcast. It's not everyone that's going to go and feel super confident about investing into some of these other asset classes. So great question. And
Mm-hmm.
again, it really is on a case by case basis. But I'd say for most people, it's like, hey, get those things started and then start looking at these more elaborate strategies. Because here's the other part. I see that as being one of these, like, you're like throwing a big tree down on the path and blocking you from starting on the path. Like, I want that path.
Right.
I want you to get down the path. I want you to get moving on the path before you start adding things that you have to sort of hurdle over on the path. Like, I got to learn about this. I got to do it right. What if I mess up? Make sure you get started. And again, permanent insurance, probably not a good move unless you've consistently been contributing to those tax-free buckets, at least for a period of time. And you're actually putting them into investments that are going to give you a fair return for the type of risk you're taking on.
All right. Perfect. Okay. So that gives me a little bit of a clear picture of who, you should be if you're listening to this right now and you're like, okay, I have thought about my life insurance and I'm thinking specifically it's for covering and my life and my beneficiaries can get paid out if I die. It's like a just in case type of thing. Then permanent insurance is not for you. Or if you're just getting started on this journey and you're not, you haven't started these fence post steps of RRSPs, tax-free savings account, and it's probably also not a good move to do this other thing yet. Let's get those things rolling first. All right. Now, what about this is the thing that I always thought about that I wished I had done is that maybe if I was that person who was getting started, like I got some discretionary income. One of the things that we've advocated here on this podcast is we do want to have that emergency fund sticking around. Like we do want to have that money sitting over there. And we've talked about using a policy as a replacement or a tool to help us, fund an emergency fund. And that might be a good spot to go. It's if I have an emergency fund and I'm contributing to my emergency fund and I'm not going to use an emergency fund, then maybe a whole life policy isn't for you. But if you are going to use an emergency fund and it's going to sit there and do its thing, then maybe consider using the whole life policy or the permanent policy is a good tool to build that emergency fund up.
100%. So on episode 54, we talked about supercharging your emergency fund. So this would be one of those scenarios where, hey, maybe you haven't yet gotten on the road to filling up those investment buckets that we just, discussed, right? So this is like an asterisk. You go, listen, if I was going to build this emergency fund anyway, the reality is most people can't just go, boom, emergency fund
Right.
created. You
Right.
have this goal in mind, right? You're going, hey, if I follow the Dave Ramsey's of the world, or even Ramit Sethi and
Yep.
his approach, whatever approach you're following for an emergency fund, definitely a good thing to have. And if you're going to do that, you're probably going to have to budget that payment in. So you can kind of hit two birds with one stone by starting that emergency fund, whatever that contribution was going to be, into a permanent policy. You're going to get all kinds of bonuses. Not that you're doing it for quote unquote the death benefit now, but imagine this world where, hey, if it's going to take you X number of years to get to that emergency fund to the size that you want it, you can continue. You got used to that budget, continue to fund, and then now start to look at a portion of the cash value in that emergency fund as a leverageable bucket for investment. So I love that idea. One other aspect that I want to share here is the idea of those who are, say, melting down RRSPs, for example, or maybe receiving a pension. what you'll find is that the RSP, first of all, if we look at it and we look at it early enough, some people are looking at it and saying, whoa, my RSP is big, good problem to have.
Right.
If I don't start a meltdown strategy, I might actually push this thing off too far into the distance where it becomes too large. And then eventually I'm giving away more than half of it in taxes. Now we run that. You have to run the numbers and look at it, because if you're already in too high of a tax bracket, then it's damned if you do, damned if you don't. But if you're like most people, you're trying to keep that tax bracket at least under control. You don't want to be in that highest tax bracket, of course. So when you're taking that money out, or when it converts to a RIF where you have to take money out each year, then you may have more money coming to you than you actually need. I want to fill up, of course, tax-free savings. I want to look at other opportunities. But then if I'm looking around and I go, I don't have any other tax-free buckets to put it in, this is another great opportunity for people to do. So they might be looking around and saying, shoot, I've got more money coming in, people receiving a pension. They don't have a choice of how much money they're going to take. Again, good problem to have. But if you have
Mm-hmm.
more money coming in and you don't have room in the tax-free savings, or you don't have room over there, and here's the other part. For a lot of people, they're getting to a point in their life at that place where they might want to de-risk anyway. So rather than, say, selling off growth assets inside the RSP or inside the tax-free savings account, this money that's forced out, you could be opening up this other tax-free bucket, a permanent policy, so that that can act as your risk off sort of growth asset. And then
Mm-hmm.
you get all the other benefits. So if that's not you, if you're looking at your RSP and you're going, you know what? I mean, it's not even going to provide me enough to get by. If that's you, I don't think it's our listeners to this podcast, but if it is, then of course a permanent policy is not going to make sense for that individual, right? You're going to take
Mm-hmm.
what you need for
Mm-hmm.
living, and that's it. And we're going to try to have a strategy within those tax-free buckets you already have to continue living your lifestyle.
All right, I'm going to move on to a different reason you may not. This might not be, for you, and specifically, those are the people who are not looking to leverage, or
Mm,
have a mindset issue about using other people's money to make money, right? So, like thinking about like if I go and get a whole life policy and I have my cash value and I am paying for, these premiums are larger than term premiums, but this cash value is going to grow. And I have an issue I have a fundamental belief about I don't want to have debt. I
mm,
don't want to borrow against the policy to utilize that and go and buy real estate or use it to do something with, that can help build your wealth. Then this might not be the tool for you, right? Like maybe if you're just looking to grow, like then that's where it's like then definitely be maxing tax-free savings account. Like maybe just going in and doing an unregistered account in the index funds are your thing, because you can't actually leverage. Well, I'm not going to say you can't, but I mean it's harder, or it's not as, optimal to
common.
leverage against,
Yeah.
or common to leverage against, say, those types of assets. And most people just say don't leverage there, and that might be your area to kind of build your wealth, because you have that I don't want any debt. And if you don't want any debt, you don't want to be able to, say, borrow someone else's dollar to go and make another dollar. Like
Yeah.
that's like that idea. Like if you don't have an issue around that, and if you're talking to like real estate investors, they consistently, borrowed other people's money because you've got a mortgage, or you've loaned private money, or you've got other sources where you're buying properties and then releveraging those. And like that's common for that type of person who's using that tool in that way. But if you've got that issue, this tool, because you have the cash value, because banks love that class A asset that says, I would love to have that on my balance sheet to say to lend against, for you to go and use this to leverage against and go do something else with. I'd love to lend you that money. Um, if you don't want to use it in that way, this policy is not probably your ticket.
A
Go
hundred
find
percent.
go find something else. You probably get better returns if you go find something else. But if you're interested in going, I'm going to put two uses to the same dollar, then this is the thing for you.
Absolutely. And I also want to, just kind of piggyback that idea around inflation, right? And, something that is easy to forget. So when I borrow, we talked about this in early episodes, when I borrow a dollar at whatever interest rate, the reality is interest rates tend to move with inflation rates. Like, did you
Right.
notice that? Like when inflation went up, all of a sudden interest rates went up. So when you think about this and you go, if I'm borrowing money, it's like I'm borrowing it at a higher interest rate. The reason the Fed does it, the reason the Bank of Canada does it is so that you stop borrowing. they want you to stop spending money.
Right.
But if you're doing it for investment and there's arbitrage there, as you've mentioned, you're arbitraging, you want to get a better return than what you're borrowing. The other reality is the fact that the dollar you borrow today, when you pay it back next year, 10 years from now, however many years from now, that dollar is no longer that year's dollar. It's like it's
Right.
actually worth a lot less, meaning it actually becomes easier to pay back. And this is what some of the most wealthy individuals in the world have recognized is they go, when I borrow $1 million to make an investment and I only have to put 20, 30% down, whatever the number is, they know that there's like a good chunk of money there that they are going to slowly pay back over time at an interest rate, but
Right.
it's going to cost them less and less over time. And the growth of the asset typically outpaces, if it's a good asset and if it's a good investment,
Right.
it's going to outpace inflation. It's going to outpace the amount you owe. So these are really important things. But if that's not you, if you're like, I am not going to go down that rabbit hole, then it's like, yeah, then do not do this particular, this particular strategy. Two more here, John, two more before we wrap up. If you are not an incorporated business owner who's earning active income or even passive income. If it's active income, you're going to get taxed very heavily on the retained earnings coming out to you personally. If I want to spend that dollar here in Canada, that is a big issue. If you're not an incorporated business owner, then it might not be of urgency to you. But if you are and you have retained earnings, those active dollars are taxed at 12.2% here in Ontario on the first 500,000. As you accumulate those inside of that corporation, at some point, you or another shareholder of that company is going to want to spend those dollars. You're going to get, big taxes on the personal side coming out. Permanent policies with leverage strategies allow us in compliant ways to utilize those dollars. For those who are real estate investors, John, you and I experienced this in one of our corporations where you pay passive income taxes, like 50% of the upside goes away through passive income taxes. Well, guess what? Through leverage strategies, we can knock down that passive income taxes and we can increase the amount of tax-free money that comes out to shareholders with permanent insurance policies. So again, if you're not an incorporated business owner, it's not going to be as attractive to you, of course. But if you are, holy smokes, I could buy the same policy as John personally buys with 60-cent dollars after tax or 50-cent dollars after tax, and I can do it with 88-cent dollars. And I can use leverage strategies to minimize taxation on a personal level. That's phenomenal, right? So those people are perfect fits. And then the final one here, John, I want to talk about is if you do not care about legacy, all right, if you do not care about how much of your estate's going to be taxed once you move on to the next world, I always say when I'm 110, then permanent insurance isn't for you. Like term is fine. You'll cancel the term before death and there will be no payout. It'll be just an expense of life. But if that matters to you, then you're going to want permanent insurance to be a part of your strategy in some way, shape, or form. But here's the challenge, John. As we get older, even though today, 41-year-old Kyle may not really care about legacy a whole lot, it's very a known fact that as we get older, we start to care more and more about leaving something behind here in this, place we call, our world, our lives.
Yeah.
And
Yeah.
we want that legacy. So you don't know who you're going to be down the road. But if you think that might be on your radar, then it might be worth considering. But if not, then again, permanent insurance, probably not a good fit for you.
Love it. Love it. Thanks. Thanks for, getting to those last two reasons that may not, permanent insurance may not be your thing, your ticket to build your wealth. If let's say you listen to this episode and you're like, I might need to listen to this again because I'm trying to qualify, is this the right tool for me or is this not the right tool for me? And if you let's say you listen to this twice, and at the end of that second time, you're not sure still, is it the right tool for you? We'd love to help give you that qualification. We'd hop on a call with us, go over to CanadianWealthSecrets.com/discovery, and we'll hop on a 30-minute call and we'll kind of hear your scenario. We'll hear what, you know, what tools you have been using, where your goals are. We'll kind of dig in, and at the end of that call, you'll know with certainty whether this is the right tool for you or not. And we'll also, help you with the other tools that you could be utilizing in that call. And we'd love to do that. We do that every day with the listeners here on the Canadian Wealth Secrets podcast. So head on over to CanadianWealthSecrets.com/discovery.
All right, my friends. Hey, listen, if you enjoyed this episode, do us a huge solid. Give us some feedback on Apple Podcasts. Ratings and reviews are super helpful. And they're, of course, motivating to keep us helping more Canadian Wealth Secrets along their journey. We'll see you next time.
Just as a reminder, the content you heard here today is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. John Orr is a mortgage agent with Bricks Mortgage, license number M23006803. Kyle Pierce is a licensed life and accident and sickness insurance agent and VP of corporate wealth management with the Pancourt team, which includes corporate advisors and Pan Financial.